Good afternoon, everybody. We are on the home stretch. I'm sure all of you are starting to get a little bit tired, but bear with us. We're only a couple more sessions to go. Hopefully, especially because this is a little bit of a smaller group, we want to make this interactive, so feel free to ask questions, make comments. We probably will ask you guys some questions, so please try to participate. Hopefully we can all get through this together. Again, I know everybody's probably getting tired. Today what we want to talk to you about is automating your account reconciliations and really looking at why you might want to consider trying to automate that, what benefits you can achieve from automating that. We've got Mark here from E&Y, and he's going to talk to us kind of high level about account reconciliations. I'll talk to you a little bit more about using technology to help drive efficiency as well as gain better visibility into your close process and account reconciliations, as well as have better control around that. And then Wendy from Atlas Air Worldwide is going to cover it from a case study perspective and tell you about how when Atlas Air implemented it, kind of what they looked like before and then how things looked afterwards. With that, I'll go ahead and turn it over to Mark.
Sure, thank you. Can everybody hear me okay? I don't think, I'm not sure. Okay, perfect. So as Susan mentioned, today we're going to talk a little bit about account reconciliations, just a little bit of background about myself. I'm with E&Y, been with E&Y for about 5 years now. I'm in our performance improvement finance practice, which covers a wide variety of finance areas. The last few years I've been focused on financial statement close, and the last year or two I've been focused on account reconciliation specifically. I'm actually currently implementing Blackline on a project that I'm on right now, so I do have a little bit of experience within tools and technology. Now I want to start the presentation by going over a broad overview of what we consider the financial statement close process. And then we'll get into a little deeper dive into account reconciliations. So at EY, we break down the financial statement close process into 5 major areas, starting with data collection, then we go into the actual entity close, consolidation of the financials, reporting and analysis. Account reconciliations fall under the second phase, entity close and submission. This next slide provides an overview of the typical processes under each phase, as well as whether that process would be supported by a typical ERP system such as SAP or complementary software such as account reconciliation software or different software. And as you can see under process 2.1, reconcile general ledger accounts, this is a typical process where you will see a complementary software used. This next slide goes into some examples that we've seen in the field at different clients on issues that they're having regarding account reconciliations. And we split the slide up into process, issues, and results. And I'll just go over a couple brief options, and then I'll go over some client-specific examples. Typically, we go out to a client and we'll see reconciliations performed in Excel, performed in Word, manually performed, not timely, limited visibility. Sometimes they'll track the reconciliation progress in Excel. They don't have a centralized dashboard, which leads to a couple issues, specifically inconsistent applications. So you could have certain business units performing account reconciliations in a different manner. Lack of approvals, maybe inappropriate segregation of duties. I had a recent client where they didn't really have approvals on certain account reconciliations. A lot of them were prepared, but they didn't end up getting approved. And it leads to 3 major things. Number 1, financial statement risk. So you're not really confident in your financially reported numbers. If you're a public company, compliance risk, so Sarbanes-Oxley risk, and inefficient processes. So the value proposition, and I'll get into this a little deeper on the next slide. But the goal of implementing a tool and what you want to achieve would be you want to standardize the account reconciliation process, centralize it, and automate it where possible. And you can do this by really creating efficient, visible, reliable, confident, and better manage overall risk. Really, it comes down to 2 things, in my opinion. You want to keep out of trouble, so the compliance aspect, and you want to make the business better, which is really the operational improvement aspect. And then the rest of the slide lists more in detail those areas. For example, completeness validation, auditable support, and approval certifications to be able to. I think Susan's going to dive deeper into the actual functionality of the tool. As far as process improvement, automation of controls, so a lot of tools today for account reconciliations. If you have, for example, an account reconciliation that has a zero balance and there's no activity in that balance sheet account, it'll automatically certify it. So a person doesn't have to go manually into the GL and check out the activity. If there's no activity in zero balance, it's automatically certified. There's also potential to reduce audit fees. So when you move to a tool, typically auditors will move from manual control to an application control. So a test of 1 versus a test of 25, which can help reduce audit fees. There are a couple other systems that as well. So what's the business case from moving to a manual Excel-based account reconciliation process to a tool? This was a slide that I created for a controller a few months ago. And she was just looking for, we were pitching an account reconciliation tool, and she was looking for a business case why she should implement this. And typically when we think of a business case, we think of dollars and cents. So where does the savings going to be? In this case, there are some quantitative benefits. For example, like I mentioned, reduced audit fees, paper savings, could have storage savings, but really the business case end-to-end had to include compliance and operational benefits as well as qualitative benefits. So when you think of those, you think of items like completeness validation, workflow, segregation of duties that's automated instead of manual control, a process that's more risk-based rather than reconciling every account on a monthly basis. Maybe you implement a risk-based approach where you reconcile certain accounts on a quarterly basis if they're not in order. This next slide covers a process overview. It's very basic. The process is going to be different based on your organization, obviously. Number of business units you have, number of accounts you have, number of users you have. But this provides a high-level overview when you do have a tool in place, what the process looks like. And typically what we see is you might have a corporate function, and then you might have different facility level or business unit functions where the reconciliations are actually performed. If you do not have a technical landscape, it's hard to combine these two, and it's hard for them to communicate because they're totally separate functions. But when you do have a tool, you have a workflow, web-based forms, everything's in a central repository, therefore combining the two. I had an example of a recent client that their controller, their assistant controller, and one of their VPs of finance traveled across the country every close for a week just to get all these reconciliations approved and manually signed off on. They've since implemented a reconciliation tool, and they no longer have to travel across the country, which is nice, but they've also gained a lot of efficiencies within the process. And this next slide is just a high-level implementation approach. Wendy's going to also cover this on how she implemented it at her company, but this is just a high-level process that we at Ernst & Young go through when we implement a tool like this. We start out with a basic assessment to see if this tool is actually right for the company. We go into design, develop, train, test, and roll out and control. One thing to keep in mind is it's not just putting a system in place, but there's a lot of process aspects that go with implementing an account reconciliation tool. For example, my last client, we entirely redesigned the process, wrote them a new account reconciliation policy and procedure documents, and performed all the training for users. So it's more than just putting a tool in place. I'm going to pass it to Susan now. Here's my contact information. If anyone has any questions, feel free to reach out at any time. That's to you, Susan.
Okay, really quickly, I'll tell you just a little bit about myself. I am the Director of Finance Transformation at Blackline Systems, and formerly I was Associate Director of Strategic Initiatives and Global Flows for Apollo Group, which is the parent company of University of Phoenix. I've also worked at assistant controller for Weezer Homes and several different other companies. The biggest thing really that I wanted to say is that I've really focused my career on looking at the close process and helping companies drive efficiencies in that, as well as making sure that the activities that they do are adding value and that they're appropriate. And as I go through this, I'll kind of give you some examples of what I mean. Before I start out though, let me ask a quick question. How many of you are still using Excel or spreadsheets to perform your account reconciliations? Okay, and how many of you are using technology? Internally developed software? Okay, so mainly spreadsheets. And how many of you are using spreadsheets to track the status of those? Sign-offs, things like that? Okay. Really quickly, and I'll go through this fairly fast because I think we've heard it all day long. The idea here is that controllers, CFOs, finance and accounting professionals are all super busy. We always have been, we always will be, but now things are really shifting. We're getting pulled in different directions, and we're being asked to participate in other parts of the business that maybe we weren't exposed to before. And so, as much as we can, those normal day-to-day activities, we want to try to automate those and get away from them. This slide here really is just kind of talking about some of our current regulatory, the current regulatory environment. Again, the idea here is that things are changing. We've got new accounting standard setters, we've got changes in, we're still talking about the IFRS conversions, nobody knows exactly what's going on with that. We have changes to the new updated COSO framework. I don't know if any of you have taken a look at that, but again, it's going to be more controls. So really, we want to make sure that we're efficient as well as that we're maintaining those controls. So what does it mean for the corporate finance department? Well, basically, it means that for CEOs and CFOs, they need to be more meticulous in what they're looking at. It's up to you guys to make sure that the numbers that you're reporting in your financial statements are accurate. One of the best ways to do that is through your account reconciliations. For those of you that may be expanding through mergers and acquisitions or changing the business, adding new product lines, things like that, your books are going to get more and more complicated, or you'll have multiple sets of books. When I was at Apollo Group, one of the reasons why we turned to a tool is because of the fact that they started adding schools that were based out of London and Chile, and when Mark was talking about somebody having to travel across the country to go and look at other reconciliations, well, that's about where we were, and it's just not possible. You can't do that. Again, having to maintain multiple sets. If any of you are global, you may have to deal with different types of regulatory requirements. And then, again, just making sure that you're focusing on those key control activities, account reconciliations being one of them. So what's happening is a lot of these new rules, people are starting to get worried, is IFRS going to go through? Is my revenue recognition going to change? With the new COSO framework, what does that mean? Am I going to have to go through and do a brand new risk assessment? Am I going to have to add on a bunch of new controls? Am I going to have to do additional tests? Is my sample size going to increase? Things like that. Well, that causes confusion. A lot of times, people feel like there's lack of visibility, not really knowing what's outstanding. As far as reconciliations, there's little to no standardization. How many of you have actually looked at all of your account reconciliations? How many of you know whether or not the account reconciliations that your teams are preparing are just a roll forward or a regurgitation of the GL? If you haven't looked, look.
Regurgitation.
Look. It's just a repeat of the general ledger. Look at your account reconciliations and see what they're doing. Because as I've gone to different companies, whether it was when I was an auditor or as a controller, I guarantee you'll find some accounts that are going to be simply a repeat of the general ledger. That's not really a true reconciliation. You need to understand what's going on in there. I've seen a lot of accounts where they use roll forwards when it's not really appropriate to use a roll forward. Again, that's just telling you the change in the balance, not whether or not the actual total balance is accurate. Too many manual processes. That was one of the biggest challenges that I've seen in the past, is that We have thousands of accounts, and in order to go through and populate all these spreadsheets, you're just doing a bunch of data entry. By the time it's closed, the books are closed, you don't have time to go in there and really analyze what's going on. And that could create a problem for you. And again, being manual, that leaves room for error. We've heard a lot of different stories about spreadsheet errors and how it's cost companies a lot of money. And that holds true. That is one of the problems with spreadsheets, is that you can't always control what's getting put into it or the formulas and ensuring that those are accurate. So when we think about account reconciliations, there's a lot of different factors or things to think about. You've got data that's coming in, your general ledger balances, your sub-ledger balances, your bank account records, or your bank statements, all of those types of things. You've then got your accountants or your preparers, and they're putting together those reconciliations. It then goes through to an approver or a preparer. Maybe management wants to look at some of those account reconciliations. Maybe they're high risk. Then add on top of that the auditors that want to come in and look at that. So you've got a lot of information that's changing hands. How many of you have ever had your auditors lose work papers? Okay, well that's one of the other issues, that it's all manual. It can even get lost changing hands between the preparer and an approver. I've had that happen before. I've had to make preparers go back and redo a reconciliation because it wasn't on my desk. Another thing is, sometimes we have late journal entries come in. Maybe those entries get booked top side, but they don't actually get pushed down to the general ledger. Your auditors come out, they look at your account reconciliation, and you have a difference. That can create problems for you. One of the nice things about using a reconciliation tool is that if the balance changes at any point in time, even after you've certified that the reconciliation is done, it will decertify that reconciliation and notify the preparer. So it helps give you that extra bit of protection. Again, that's just another nice little feature that you're not going to get from a manual process. I like this picture just because I can totally relate, again, during the close, everybody's working long hours, you've got a lot of pressure, management wants the numbers, the accountants are getting tired, they're trying to get everything done in a short amount of time. As much as you can, use technology to try to speed that process up and eliminate some of the stress that comes during the close. Enough said, I guess, really. Organizations are getting more and more complex. And I know when I was at one company before, we were struggling with all of these new accounts that we would go in and add, making sure that the appropriate person was notified so they would know to prepare it. When we actually went to implement a tool, oh my goodness, we found accounts that 2 different teams were reconciling, so it was getting double the work. We found a couple of small ones. Luckily, they were immaterial, but some things that weren't even being looked at. So again, if you implement a tool, then you're going to know every single account that's out there, and you can make sure that those are appropriately being accounted for. So hopefully you won't find yourself in that position. We've already talked about existing methodology, spreadsheets, internally developed software, and obviously technology. I like to think of the account reconciliation, we want to look at it from kind of a world-class process. There's several factors that go into it. One is standardization. Standardization, again, refers to, are all of them being consistently prepared? Are all of them being prepared in an appropriate manner? Or are they misusing roll forwards and repeated the GL? Control. Who's responsible for preparing that reconciliation, and when is it due? Who's responsible for approving that reconciliation, and when is that due? Has it been completed on time? What are my required adjustments? Availability, as we've all talked about. Here all of us sit today. I'm sure there's lots of business taking place that you're responding to emails and you're checking on things. So to have that access to know at any point in time where things stand within the close and what's been reconciled, what hasn't, not only from a number standpoint, but more importantly from a dollar standpoint, as well as what your risk or exposure is. What are those unidentified differences? To me, that's another area that always kind of concerned me. I had thousands of accounts. There's no way that I would be able to know in aggregate what my risk was. Some were over, some were under. I don't know what the total was. Training. It's important to make sure that we've got good training. They don't teach how to prepare an account reconciliation in school. At least they didn't when I was there. Now, that was a while ago, but they don't. And so your accountants come out, they come on board. Guess what they're going to do? Same as the last person. Guess what they did? Same as the last person. How do we know that it's right? And the last thing is around policies and procedures. How many of you have an actual account reconciliation policy that's up to date? And how about your desktop procedures for the accounts? So for some of you, you have it. For others, maybe not. Again, another potential area for risk. If you don't tell your accountants what they need to do with, let's say, an unidentified difference, you need to write it off if it's X amount. Or if you're going to write it off, you need to go to the controller and get their approval. If there isn't a policy in place, they don't know exactly what to do with those things, and they're not going to get managed effectively. And if there aren't procedures associated with those reconciliations, if the person that normally prepares that is out, somebody else is going to have to fuddle through it. So, again, very quickly, when we talk about standardization, one of the nice things when you look at a tool is that there are templates that are available. So let's say, for example, you've got a prepaid account. There's an amortization schedule, so literally all your accounts would have to do is enter the invoice amount as well as the schedule or the time frame, and it'll go ahead and amortize it for you. So that's one less calculation that they have to do, one less Excel spreadsheet that they have to try to manage and keep track. And if it's a company that has maybe a lot of prepays, sometimes I've had it happen before where something gets off on the line and then suddenly you've got big differences. Another nice thing about that is that as long as you've got nothing new, then it should, because of it automatically doing the amortization for you, as long as you book what your amortization is according to your amortization schedule, those should tie and will automatically reconcile. So that's one less thing that your accountants actually have to physically go in and prepare as a reconciliation. A couple of other things, it's got a place where you can put the policy as well as the procedures for that particular account reconciliation. You can attach all of your supporting documentation. So instead of having big binders with the face of the reconciliation and then a lease agreement behind it and any other supporting documentation, you can go ahead and upload it into the tool. Not only then can your preparers access it, but approvers, management, as well as your auditors, which makes it nice because that somewhat minimizes the go-between and the questions that come back and forth, because all the information should be held right there within the reconciliation. And of course, it also gives a full audit trail, so it can tell you when it was certified. If it was decertified, it can tell you when it was decertified. Visibility and control. Again, as I mentioned before, it's nice to be able to see where you are at any given point in time. It's nice to be able to run reports and see what are your required adjustments, what are your open items, and how long they've been outstanding. Again, just helps to better manage those and make sure that they're being addressed in a timely manner. And we've kind of covered this already. When we talk about looking at the overall close process, again, really it just comes down to there's a lot of information that's coming through the finance and accounting organization. It's then getting dispersed through a lot of different people. And so really we want to try to bring that all together. If you are considering a tool to help you with your account reconciliations, here's just a few things to look at. One, you want to make sure that it's for the entire balance sheet. It's not going to do you any good only to pull in a few accounts, because you're going to lose that control aspect of making sure that every single account is being reconciled. Auto certification, again, that just helps to speed things along and lets your accountants get away from just that manual data entry into actually analyzing the accounts that need to be looked at. Templates to help for standardization, something where you can upload your supporting documents so that it's a holistic approval workflow. It's nice to be able to set it up so you've got your approver and your preparer, and then an approver, reviewer as well as if necessary. Reporting, global access, you guys can see the rest. I'm not really going to get into this because I think all day long we've kind of talked about in the cloud, and at this point I think you guys are pretty familiar. I think these are going to be distributed as well, so you can read these. This one really quickly, you can see here some of our clients and the ROI that they achieved. Again, it's a pretty simple thing to implement, yet the ROI is so great. For me, more importantly than the ROI though, really, is the peace of mind, just knowing that all of my accounts were reconciled, knowing that all of them were reconciled in an appropriate manner, and knowing that if for some reason the balance changes, I'm going to be notified and that we'll correct that. That's worth it. So now I'm going to go ahead and turn it over to Lindy.
Hi everyone, good afternoon. As Susan said, I'm Wendy Shapiro. I'm the Senior Director of Corporate Accounting at Atlas Air Worldwide. I'm going to quickly just let you know who we are, what we were like before we automated, why we chose to automate, what our implementation was like, and then the benefits that we got from automating, and a little bit about what our auditors think about how we automated. So Atlas Air Worldwide, we're the leading global provider of outsourced aircraft and aviation operating services. We're located in Purchase, New York, which is about 30 miles north of here. We're the largest operator of Boeing 747 freighter aircraft, as well as 747 and 767 passenger aircraft. We have customers such as British Airways, Etihad, DHL, Qantas, etc. And in 2012, we operated more than 22,700 flights, which is pretty good. Okay, so what were we like before automating? So it looked like a lot of you were still sort of on a manual process, so you'll probably relate. For those who may have switched, you may cringe thinking back to what it was like when you weren't automated. Excel reconciliations, are the formulas even right? Getting information in different formats, no standardization, as Susan said before, drowning in papers and papers and papers and binders and all of that. Which was the final reconciliation. We had that a lot. You'd hand in the reconciliation, somebody would put through a late journal entry, you'd hand it to your auditors, there may be another one floating around, it doesn't tie out, you had no idea which one was final. And then you started to lose some credibility. Filing everything, reconciliations, journal entries, SOX documents, photocopies for your auditors, external, and then for internal, then to keep a copy in case somebody lost something along the way, then one to hand in, etc. We have international locations, so I know Mark said somebody used to fly out to look at reconciliations at one of his clients. We FedExed everything, so all of our international recs and journal entries would be FedExed with signed copies. Some locations would scan, which took up disk space, that costs money. Documents disappearing, Susan mentioned this too. They would get lost. I swear some of them had legs and you just walk away. And we had very stressed out employees over doing administrative tasks and not really focused on the work that they should be focused on. So why automate, other than all those reasons? We wanted better visibility into our close process. How many reconciliations did we really have? How many journal entries did we have? Trying to standardize all of our checklists. We wanted automated workflow. We didn't want to have to walk up and downstairs and pass things around. Business continuity was a big one. Cost savings. Yes, we wanted to spend money to implement a system, but we knew that there would be cost savings in the long run. Streamline processes, risk mitigation, the efficiencies between the international locations and headquarters. One system for everything, for account recs, for journal entries, for all of our checklists. And as I said before, efficiencies for the internal and external auditors, and employee morale was a big one. So we looked at a bunch of different systems. We looked at developing something in-house. We looked at some outsourced ones. And we signed a contract in Q4 of 2008. So we've been automated for a pretty long time now. We had a phased approach. We signed the contract, and it was about not even a month later before we went live with the variance module. So for those of you who have to do balance sheet variances, does anybody have balance sheet variances for monthly close and to give to the auditors, different quarter-over-quarter, year-over-year, etc.? So we now had that live for our year end in 2008, and instead of sort of running a balance sheet, exporting it into Excel, exporting the one from the other period, worrying about if it changed, typing into Excel, getting different versions and all of that. We now have a system to do that. A few months later, we implemented the task module, and this was all of our checklists. We implemented all our standard journal entry checklists, some SOC stuff, PBC lists we started to do as well. And then a month later, we did our account reconciliation module, which is a lot of what Susan talked about. And we had all of our balances from our ERP system brought into our automated solution. And we now started doing all of the account reconciliations online. We looked at that for a little bit and then decided we were going to put all of our journal entries and automate those as well. So in August of 2010, we implemented the journal entry module. It only took us 6 weeks to do. We thought it was going to be 3 months, and it was 6 weeks, and we were live. And now we had everything in one system. In October of 2010, we implemented the matching module for bank reconciliations, and this was a module that basically takes 2 very large sets of data, small, in this case large, and matches them against each other. So we brought information in from our Treasury workstation and information in from our ERP system for all of our bank reconciliations, and they would automatically match the transactions and kick out what was missing. We used to have 3 people that did our bank reconciliations. We had over 100 bank recs. Today I have 1 person and a couple of people doing a few here and there. And then actually just this year, we implemented auto certification, which Susan also talked a little bit about, and so did Mark, where we have some smaller accounts that either always 0 balances or the balance doesn't change, and those can be auto certified. Some recs only change at the quarter, so they'll auto certify each month, and then at the quarter, there's a change in the balance, so it'll go through the review process. We also, for prepaids, where we have amortization tables, you can auto-certify based on calculated balances. So as long as the balance that calculated in the reconciliation ties to your GL, it'll auto-certify. So that saved a lot of time. We now have 20% of our reconciliations that are going through auto-certification. And then we have a bunch of ongoing projects today to even help automate the process more. There was minimal IT resources required. I pretty much implemented it, so that was nice. We didn't have to wait for their resources to implement. We can do it ourselves. And we have about approximately 85 users worldwide today on the system.
When you began in the 4th quarter of 2008, was this always the roadmap?
No, it actually wasn't. We thought that we were going to go live with account reconciliations first and figure it out from there. And what we realized is we wanted to do some more stuff than what was available in the system at the time. So we tabled that and said, well, let's start with variances. And immediately we saved about 2 to 3 days in our year-end close process just because of that implementation. And we didn't even think we were going to use tasks, and when we finally sort of got into the system and saw how easy it was, we moved that up as well. So, any other questions? Yes.
For example, in the variance module, what exactly does it do?
So what it does is it takes, you already have your GL balances in there that are being brought in for your account reconciliations. And then you have rules that it'll run. So what it will do is it'll look at, if you're going to do a month-over-month variance, it pulls in the balance from, let's say, January, and the balance from February, and it calculates what the difference is. And then based on whatever your particular rule is, if you want to explain variances that are 10% or over $500,000 or 10% and $500,000 or whatever your rule is, you put that in and it pops out a list of all the variances for the accounts that need to be explained. And then when you go into the module, you type in the amount that you're explaining and you type in your difference, and it'll show you how much you still have left to explain, and so on and so forth. And then you can run a report and give it to your auditors, or your auditors can go in and look at it themselves.
Does it look for any large entries that might explain it?
It does not look for large entries. People have to go in and still explain the balance.
So it's just calculating the variance.
It's calculating the variance and giving you a nice tool to use to explain that variance And if you do have a late journal entry that wasn't originally on your variance, we'll update it and automatically populate it for you, so you don't miss something that you need to explain.
Are you going to show an example of an account reconciliation?
I do not have one, no.
I just want to know what it looks like.
If you stop by the black line booth after, we can show you. Okay. Any other questions to this point? So, the benefits that we've realized from automating. Cost savings. As I said, we used to have 3 people doing getting reconciliations. I now have 1 person. There's been a ton of other cost savings, just paper, binders, binder clips, all the postage and freight and disk space and all of that kind of stuff. We also did, our audit fees were lowered, as Mark said sometimes, that, audit fees will be lowered. Our audit fees were lowered when we implemented and the system was up and running, even though we were growing as a company. Business continuity. This for us is a big one. We know that where everything is, if an employee leaves and the new employee comes in, they can go back, they can see what's done. Their policies and procedures are right there for them. They can go back and look at prior periods without having to go to binders or file cabinets and pull everything. That was a big one for us. The ability to close remotely. So we had one year end where we had all of our journal entries due and there was a huge snowstorm. And it was our year-end close. And we actually finished in our close. Everybody was able to do it from home, even though our office was closed and nobody could get into work. And we did not have to move our year-end close schedule. That's a big advantage. The ability to access prior periods. We have fewer SOX deficiencies now. People don't forget to do things. People don't forget to tie out balances. Documentation for the reconciliations that remain unchanged. You don't need to reattach. So in the prepaid example, you have a prepaid, it's amortized over a year. You attach it the first month. You don't have to attach it again after that. It stays there until that item is closed out in a year from now. We talked about variance analysis. We are now able to file our 10K 10 days earlier. We cut 10 days out. Part of that was on our end. We didn't have to photocopy for the auditors anymore, which took 3 to 4 days sometimes just to close and then to have people to photocopy and to give it to them. And they cut time out of their audit as well. So we were able to close about 10 days faster. Our employees are happier. They don't spend their time photocopying and filing.
Is that because you're putting documents into the system that you don't have to copy for the auditor?
That's correct. So our auditors, both external and internal, have access into our system.
So they'd be scanning them in instead of copying?
It could be a scan, but we have a lot of electronic documents as well.
Okay.
All of our invoices are electronic, so it's just a save and an attach. Our auditors are happier. That makes us happier.
Were you able to get a reduction in your audit fees?
We did, audit fees, we did. They actually reduced about 5%, and they've continued to reduce the more that we've automated. Our PVC list has decreased, so that's always good. We know that our reconciliations are final, that we get to the auditors, as I said. We know exactly what schedules were given the year prior for an audit request. So there's a lot of items that the auditors request once a year, and it's on their PVC list, and you're like, what did I give them last year? I don't remember. What format was it in? And all you have to do is just go back in the system and look to see. And that saves them time because it's in the same format. We know we're giving it to them in the same format, and that makes life much easier. And that also leads to fewer audit questions. We have simplified controls to test that the recs have been signed off and journal entries have been completed and segregation of duties. It's all there for us. SOX testing efficiencies. We have all of our SOX controls for finance and accounting in the system. So the auditors just go in and look what they want to do. And we have fewer printable spreadsheets as well. And I asked our auditors one time sort of what do they think the benefits are of us automating, and here's what they had to say, which is some of what we've already said, but they have the ability to work remotely, so they don't have to come in on the weekends. Sometimes they can just do it from their other office or their home or wherever they may be. They have the PVC items there and ready. They don't have to wait for us to give anything. They have to wait for it to be certified in the system. They don't have to wait for somebody to physically walk it over and wait for that photocopy. It reduces the number of requests related to SOX controls for them to test. No duplicate requests for misplaced work papers. The multiple accounting periods that we talked about, they don't have to tie back to the ERP system. This is one of the reasons why our audit fees was reduced too, because they trusted that the account balance was correct from our ERP system, and they didn't have to tick and tie, and then how many times did you give them a trial balance, and then you're like, oh, we need an adjustment, here's a new one, and they had to tick and tie everyone, so that's part of why our audit fees were reduced, and they have the easy access to the SOX controls. Any questions? For those who haven't automated, does this make you want to automate maybe? Thank you.
What did you do with your staff with all the time that they saved? Did you repurpose them and now they're doing more beneficial work, or did you reduce your staff?
We did not reduce our overall staff. So one, they weren't there till midnight photocopying, so they do have a better quality work life, and employee morale has certainly gone up, and we have a lot less turnover. But we did repurpose some of them. They're doing more analytical work. We have grown as a company. We started flying passengers a few years ago, which is a whole nother segment for us. We did not grow our accounting department, even though we grew as a business. So if we had stayed static and we weren't growing, we probably could have reduced, but because we've been growing, it's given us just the ability to not have that staff. Anything else? Well, thank you very much for your time.